Before we get fired up, let's kind of introduce everyone. I think most people will probably know, at least myself. I'd say you probably know Pete as well, but I'm the lead analyst at Onchain, which is a relatively new venture. We've just crossed our 2-month anniversary, and really, it's all about helping people hodl. And ultimately, we try to think about it as being your Bitcoin personal trainer. Where essentially the markets are volatile, things move around a lot, and it creates uncertainty. And whilst we have no idea what the future holds, we can certainly try and use the data at our hand to prepare for it. Right? It's not about predicting; it's about preparing for it. And my co-host here, Peter Dunworth, I'll introduce you, but a great friend and an Australian, which is putting us on the map.
Good to be here with you. I've been looking forward to this, and there's so much I'm looking forward to hearing about this presentation and discussing with you. On a personal note, at the Bitcoin Advisor, this is a business that's come on the back of 8 years helping my clients do collaborative custody for self-custodying their own Bitcoin in a family office arrangement, and 18 months ago set up the Bitcoin Advisor to help people globally do the same thing. And I think we're on a very similar mission in that we want to help people not only get Bitcoin, but secure Bitcoin and ensure that they've got that for a lasting legacy to hand down to whoever they wish. So I'm excited about this and looking forward to a lot more work with you.
Absolutely. Righto, folks. I think we're coming on a few minutes in, so let's fire this thing up. So the general thrust of this session is, we're trying to really navigate these markets, and 2024 has been a very interesting one, right? We've had a lot of narrative, and I use this saying all the time that I love seeing the narrative that you see on Twitter not necessarily playing out in the data. And we were talking about this literally just before we hit record here, and when you look at market cycles, generally speaking, they're very emotional, right? Markets go from absolute bottoms where people are the most bearish they've ever been, assets are hugely depressed, and it's only the strong who remain, only people who really understand what the asset is. And Bitcoin being such a grassroots phenomena means that the people who are in the trenches at that time, when you get these bear market floors, they really understand what they own, right? Very much like a commodity, right? The gold bugs are the only ones left down there in 2016 when it's just the most beaten down asset of all time. Bitcoin is just very, very cyclical. It takes a serious amount of grit to survive that period of time. Now, between there and a bull market top, the reality is that there's a transition phase. Those people who step in low, they do take some chips off the table because it improves their life. And ultimately, Bitcoin is savings. I certainly view it as your savings. And in that regard, what do you use your savings on? Well, anything that improves your life in the future. So during bull market, you get this transition period where your initial condition at the bottom is all the strong hands are in the market. And that slowly, surely transitions as they take chips off, new people come in, they're less experienced, and you get this aggregate transition of funds from the strong to the new. And then the new essentially don't have that same conviction yet. And this is what establishes a top, right? So you get this kind of ebbing and flowing, and ultimately what we're trying to do is pull that market data out, turn it into actionable information, understand where we're at. Now, the glue here, and we'll talk about this a bit more later on, is that's the mental side of the equation. Holding those coins is a different story, right? And this is where Pete comes in. It is a physical, it's a technical, it's not everybody can look at what Bitcoin does and know what they're doing. So that's where we thought the Check On-Chain, the Bitcoin Advisor, really, really nice match, and it helps you on the mental game, but it also helps you on the physical game. Okay, so in terms of the overall flow of this session, I'm going to take you through a series of charts just to give you a big snapshot of the themes that I'm seeing in 2024, how Bitcoin's performance is really matched up, and really talking about that volatility component, right? How do we actually navigate this and use data to essentially not get shaken out? Because Bitcoin goes up and down like crazy. And generally speaking, right, if you kind of run a little mental model for yourself, if you wake up tomorrow and Bitcoin's 100K, or you wake up tomorrow and Bitcoin's 10K, more than likely your initial response is going to be very similar. It's going to be, wow, what happened? I need to understand why. And ultimately, that's what I think the on-chain side of the equation is really useful for. And then in the second half, we'll look at self-custody. Pete and I will have a discussion about all the nuances. And like, I spend a lot of time thinking about Bitcoin as psychology, and, people get further along their journey. They've been holding Bitcoin for some time. An asset that goes up the way that Bitcoin does turns from like a bet into savings, into life-changing money. And when you get along that journey, at some point, you probably realize that a cold card buried in your backyard may not be the best solution for your self-custody setup. So we'll explore that in more detail, and then we'll get through to the Q&A. And as I said, if you've got any questions along the way, stick them in the chat section and we'll get to them. So let's just open up with kind of like an on-chain 101, but I think most people who are in this room have probably heard me talk about on-chain enough, but this would be good to kind of just run past Pete because I know he's got some thoughts on it, but ultimately Bitcoin is an immutable database. That's ultimately what it is. It's an append-only spreadsheet of who owned what and when. And on-chain analysis is the study of us as Bitcoiners. Yes, it's the study of Bitcoin, but it's actually the study of us making decisions, right? To buy, sell, hold, whatever it is. And because of its organic grassroots, it is the perfect lens into investor psychology. You can read any textbook or, manual about how human beings respond to fear, greed, and various other factors. And you will see it playing out in on-chain data because we behave as a herd. The smart money get in early, they get out late in the game. The people who are brand new to the cycle, they will get in late in the game. Most of them get shaken out. Some of them learn and become the smart money later on. So there's this like rotating journey that people go over, and we can really visualize a lot of it. And I think this is an area I'll bring Pete in, but this concept of data that can't be changed, Bitcoin just is. The data that's in the network is a result of what really happened. And we compare this to the traditional finance world where you'll receive a CPI number. And if you go and look at the CPI number from 2 years ago, they've fudged it and manipulated it and changed it. And it was manipulated at the time it came out. And you're like, well, what is the reality here? So, I mean, Pete, you come from the traditional finance world. How does data kind of play into that role? And, what does it mean to see something that literally can't be changed?
It's a really interesting point you make there, because in traditional finance, we're so beholden to what the central banks and the institutions are giving us by way of information. And this is the most critical thing in asset allocation, portfolio allocation. We rely on a number of key metrics. We look at inflation data, we look at GDP, we look at unemployment numbers. They're probably the three key metrics that we look at to determine what type of assets do we want to be investing in and where do we want to be putting our capital. What's interesting is for the last, say, 15 years, China has had a very poor reputation with the quality of the data that they've released, and their China Beige Book has been subject to a number of revisions that have meant the exclusion of a whole host of key metrics that people would rely on to make asset allocations in China. What we're seeing in America, in the US, which is basically the world leader when it comes to this information because everything trickles down from the US, is that we've had a revision downwards or upwards of GDP numbers to make them look more favourable, and then after the fact revise them downwards. We've revised inflation numbers down. We've had the Jerome Powell, the Ched Fair, come out and tell us that, inflation's under control, and then they've increased rates from 0% to 5%. All of these things have happened on the back of subjective statements. And this is where, once traditional finance really comprehends and grasps what's happening on the Bitcoin network, and this is where I put the work that you're doing in understanding this, this is no longer a subjective interpretation of what could be or what I want the market to be. Your work is so powerful in that it's telling us exactly what is happening in the market at that point in time. And this is going to be a radical shift from where we are at this present time, where the bulk of economic activity is happening, to what the future holds if Bitcoin adopts and then takes on more economic activity, or a greater percentage of the world's economic activity.
Yeah, absolutely. And there's a few points there, right? Just before we move on, something that I've learned over my journey as a Bitcoiner is you get used to the fact that you can't change it. And you just eventually you reach that point of acceptance where it's like, this thing just is, and we're all along for that ride. And there's a lot of people who say, but Bitcoin's never gone through a recession. And whilst we haven't necessarily gone through like a strict recession, right? We haven't actually seen all that data collapse and blah, blah, blah. It's different levels in different countries. But by and large, what we are seeing is the early signs of what it looks like when the monetary policy is variable and human controlled. And it's chaos, right? And it depends who you ask. If you ask some of the people in the upper echelons of society, they're saying, that's great. I love it. I'm getting paid 5% on my cash equivalents. All my assets are at all-time high. What's the problem? And if you ask somebody on the street, they're struggling to pay their mortgage. Their business has gone through all sorts of hardships over recent years. And you've got this like divergence between, well, who benefits? And all of these numbers are very arbitrary. I like the idea of network effects. The CPI number is what they use to manage the biggest market in the world, which is the bond market. And yet we can all look at each other in the eye and say, I'm pretty sure that CPI number is wrong. Except the problem is the traders who go, I'm going to use my own measurement of CPI, and they go and buy gold or Bitcoin because this doesn't make any sense. They're left for long periods of time waiting for the rest of the market to be bold enough to make that decision. And this is the information asymmetry that makes Bitcoin such an interesting asset in this current environment, because it spreads through the internet. Gold, it's very hard to spread through your local gold dealer. Bitcoin spreads through the internet, and the internet is in everybody's face all the time. Okay, so I want to just take people through some of the really big picture. We won't go into too much depth, but I want to take you through some of the big kind of concepts and things that, and in many ways, I spend a lot of time with the data, but I trust my gut. And when I just like absorb all these different charts, there's been a couple of themes that have really stood out to me. The first one, and you've probably seen me banging on about this chart on Twitter, because I think it's just such a great way to visualize how interesting this cycle has been. What we're looking at is the drawdown profile, right? From the local high, not from the all-time high, only within uptrends. Now, of course, it's an uptrend until it's not. We don't know when the uptrend finishes, but if we look at the characteristics of how this cycle has played out, very, very similar to the 2015 to 17 cycle. And the interesting dynamic there is that both of those were very spot-driven markets. We didn't actually have derivatives back here. This was only spot back in 2015 to 17. 2019 and 21 was a very, very leverage-dominated environment. There was Ponzi schemes and frauds and all sorts of things going on under the surface, but derivatives for every asset, token, coin, right? Someone makes a noise, there's a token about it, and then suddenly you've got a perpetual swap on it. So very, very levered, and you can see the scale of the drawdowns that actually wrought. But this cycle, we haven't given back. I mean, technically it's 20.4%, but we've barely given back 20% since the FTX bottom. And yet in that time, we've added over $1 trillion to the market cap. And this is just astounding. We're up 300%, $1 trillion to the market cap, and haven't given back 20%. So this tells us that the market is very resilient and very, very robust. Now, speaking of being robust, I like to characterize markets, and this is a grid that I use to really understand the mechanics of, what type of market regime are we in? So it's a bit of a grid. It's basically looking at, is the market volatile or quiet? And is it trading sideways or is it trending? And Bitcoin trades very much like a commodity, where it's volatile and trending, the red zone during bear markets, where it's trading lower, but it does so with a lot of shake and bake. And then there's also the euphoric phase, the late stage of bulls, where it just gets, if you've been there for a Bitcoin bull market, you close your eyes too long and it can be over, but it is a whipsaw in all directions. So that's that volatile and trending, but both of those are what we classify as an unstable environment. It cannot go through that process for very long. You may notice, and if you're around for the FTX bottom right down here, I was tired by the end of it. I don't know about you, but I was actually mentally exhausted as a hodler. I was still in the market, but I was tired. Now, I was also tired up here at the start of the bear, right? Which is the end of the bull. That bull markets tire you out. You just don't have the mental capacity to do this for very long. Now, let's flip that around and look at the other section that we're currently in since the FTX bottom. This is what I would call, in a macro sense, all of this. If you were to zoom out and look at this on a monthly chart, all these green and yellow boxes, I would put into the bucket of quiet and trending. So at a monthly scale, this looks like a quiet and trending uptrend. But if we zoom in, what is a quiet and trending uptrend? We rally, we go sideways. We rally, we go sideways. We rally, we go sideways. It's a series of stair stepping. Now, something that's really, really important to recognize is in 2021, we essentially went from 10K to 60K in 3 months, 4 months. No support, just a vertical elevator. Vertical elevators do not build support, and this nasty looking red box on the left-hand side is the price that we pay for just going straight up. This, on the other hand, is building supports, like rallying and then pouring a new foundation, rallying, pouring a new foundation. This is extremely healthy market structure. Now, again, this chart right now, right, when you're standing on the hard right edge and it looks like it's petering off a cliff, sure, we could absolutely move into some kind of downtrend. However, I am not concerned personally about turning into this red box here because we have so much constructive price action heading higher. To me, this feels very, very robust and very strong. And I think there's one characteristic I'll leave you with before we move on. Usually speaking, talking about market psychology, you do not see people at the actual top. There are no bears. Nobody is bearish. It's up only forever. I see so many bears on my timeline. I see so many people who are expecting this to be the top. That is not what tops look like. Just psychologically, anecdotally, experience-wise, generally speaking, when everybody is a bear, it's probably not the top. That's just not usually how markets play out. Pause there. Pete, have you got any kind of thoughts or comments? Otherwise, we can just keep flying through.
I'd agree with that. And the bearish comments at this point in time, I find endlessly amusing because there's a host of capital from TradFi waiting to get into this and have a further understanding of it. We'll probably have a chat about this later, but there's there's just so much capital sitting on the side that hasn't been activated yet. A lot of the financial planners, investment advisors still don't have access to the ETFs, even though they've been approved months ago. But this reaffirms exactly what I'm seeing anecdotally.
It takes time for the wirehouses and the due diligence and all these things to happen. TradFi moves slowly. And one last thing is that I think this cycle I've found it very interesting. People's expectations are somewhat misaligned with reality. They spend a lot of time worrying about where the market should be and not so much with just accepting where it is. And that's been a very interesting dynamic to observe because markets will usually do what you expect after you've been shaken out if your expectations were just a bit too short. Now, sticking with this theme, I mentioned the exhaustion phase. So if you follow my work, you've probably come across the MVRV ratio. The best way to think about this, it's the unrealized profit or loss. This is how green the average portfolio is in Bitcoin, right? We can measure the cost basis of every coin. How in the money or out of the money is everybody? High values means that everyone's in a lot of profit. Low values means everyone's in a lot of loss. Now, notice that during the blue zones, this is that quiet and trending market structure, right? Early phases of bulls. It's a general drift higher. So what does that mean psychologically? People are generally getting better off. We're seeing our portfolio value grow, stable, secure, right? It goes up, it goes sideways. It goes up, it goes sideways. Most people, I saw that meme where it's Woody Harrelson and he's like crying, and then the next slide is him crying with using the dollars to wipe his eyes. Bitcoin's up 300% in 18 months, and people are terrified. It's amazing. We're a stone's throw from all-time high. But notice in the red circles, this is where we move into the volatile and trending. And notice how the amplitude and the whippiness and the chop in that metric goes haywire. Remember what this metric is. This is people's portfolio. They're seeing up 300%, down 50%, up 400%, down 50%. Like that whipsaw is actually what creates the exhaustion, and it creates the exhaustion near cycle tops. Now, we had a very, very brief excursion there when the ETFs went live, but so far we haven't seen that investor exhaustion, which is why I say I just feel like we have more juice in the tank because we haven't hit that point of exhaustion. I don't feel exhausted, actually. Just mentally, I like to look for myself in the data. I'm not necessarily there yet. Now, Pete mentioned the ETFs, and this has been an enormous change to market structure, but simultaneously not also that much of a change. We've seen this movie a few times before, whether it's GBTC in 2021, that was a big pool of coins that went into one place and then traded around on the inside. We've seen centralized exchanges in 2017. There's a lot of analogs to the ETFs. But one thing is for sure, these are the most successful ETFs in the history of ETFs, as quoted by people who are experts in studying and reporting on ETFs from Bloomberg. Now, we've seen in total, the market has absorbed, mind you, without a 20% correction, $18.5 billion worth of outflows from GBTC, truly an extraordinary number. We've seen a total inflow. So if you pretend GBTC didn't exist, the inflows into all of the other ETFs was 33.3 billion. And in total, that leaves us with just shy of 15 billion in total inflows. Now, it is going to be very hard, I suspect, for any ETF on any, I can't envision an asset. Maybe AI chips will try for it, but I can't envision too many ETFs that are going to compete with what we saw over the course of this run. I mean, the scale of from 0 to a billion is, the 0 to 1 moment for these things was extraordinary. And, by all accounts, the fastest uptick in history. So really a truly tremendous feat. And it's amazing that people, I just still am amazed that people are bearish and saying that everybody who's in here is a degenerate trader, but there's a lot of long-term allocators that are going to be putting coins in here. Now, I think this chart is actually a really powerful one. This has been one of my favorites of late, and I think it helps people put things into perspective. A lot of people have been looking at the ETFs as the factor in the market. Now, what we're looking at here is, think about this in the world of physics. This is some equal and opposite Newton's third law type stuff. The orange is capital inflow into the market using on-chain data. So when coins get revalued to different cost bases, we can measure the capital inflows. The blue are the people who are on the other side of that trade, the people who sold a coin they bought at 10,000 for 60. They're the long-term holders who are spending capital. Now, what I've then overlaid is the ETFs on the inflow side and the GBTC outflows, just to give you a bit of a sense of scale. So the ETFs are big. They're meaningful. They're 20 to 30% of the market on the sell side and the buy side. But 20 to 30% is not 100%. They're not the dominant factor. The dominant factor still to this day remains the Bitcoin market itself. People seem to be looking at the ETFs and saying they're the only thing driving flows. And I look at the rest of the chain and I say, well, not really. The chain is the network that we know, the spot exchanges that we know, the hodlers that remain are still the 80% plus dominant factor in this market. So the other big takeaway here is look at the scale of that inflow wave. That's $80 billion a month. This is on a monthly time frame. So we saw just an absolutely gargantuan amount of money flowing into the system. We haven't yet seen that second wave, which explains a lot of the choppiness that we've seen, right? We just haven't seen that second wave, but markets take time to digest. And this is where I talk about expectations. It's okay to chop around sideways. We've gone up for 18 months. A period of 5 to 6 months of sideways is very normal, very expected, and it's very healthy, right? So the fact that we haven't even pulled back that much, we just haven't seen that second wave come in. It'll show up, but it takes time. Now, in terms of putting things into a sense of scale, this here is comparing that. Well, it's shy of $1 trillion now, if you consider the drawdown, but at the peak, it was a market cap change since the FTX bottom to now of over $1 trillion, or 960 billion at the moment. In terms of on-chain flows, we've seen about 360 billion in total flows. And if you squint hard enough, you might be able to see the ETFs down there at 15.9. So yes, or 14.9. So yes, they are significant, but they are not what's driving that giant uptick in the orange zone. So a lot of people will say, look, $15 billion created a $1 trillion market cap, and they will impute a multiplier effect. The 360 is much closer. Multiplier, 3, 4, 5 is much more sensible. Now, some other major shifts that have occurred during this market cycle, and I consider this to be 2023 to 4, that whole period, really since the FTX bottom, especially since October last year, we've seen the CME, their open interest has now become the number one. CME is now as big as Binance. They command 30% of the futures market, and this is up from 10%. So and this is in global market share. So a serious and major shift has occurred. Not only are we seeing CME in terms of dominance in the futures market, we're also seeing options are now as big as futures. Now, for those who aren't familiar with derivatives, options are a much more sophisticated option, literally. So they give traders, investors the ability to hedge. They give miners the ability to hedge their revenue. They're a much more complicated instrument. They also speak to an institutionalization. We are seeing the maturation of the Bitcoin market through many data points. Now, whilst the hodlers remain the dominant factor, we are seeing the early signs that the institutions are now here. This is not a meme. They are actually here, and we are seeing it playing out in the data. It is still very, very early in that phase, but it is starting to happen. Now, I think I've got 1 or 2 slides left. The thing I've been covering, so as I mentioned, Check on Chain's been live for about 2 months. And we've only seen this correction. We've only been studying and writing about this correction. We came in just after let's call it the peak or a peak. Now, this is a fantastic metric, one of a really brilliant construction that looks at the age of coins that are on the move. So think about this like the time-weighted volume. When the hodlers are selling, this metric will be the one that flags it. And as you can see, we actually hit a pretty significant peak, right, on those ETF flows. So a lot of people will look at this and say, oh, look, the top is in. And the way that I would frame that is maybe. But a better way to think about it is a top is in. But is it the top? That is a very, very different question. If we had have had a very violent reaction and the market chopped around and we started to see it, we may see that. But so far, it still looks relatively benign. We've seen a peak. We've seen that overall the spending behavior by these older hands is starting to slow down. Well, there's a bit of an old spend with Mt. Gox, and there's a few overheads and things to get through. But the final chart that I want to close on is, yes, lots and lots of people bought the ETFs. Yes, we've seen huge amounts of capital inflow. Is it the top or is it a top? And I've been considering this concept of top heaviness. And the idea here is what is the mechanic that creates a bear market? Just because an indicator turns red, just because something that worked in the past has gone into that level, it doesn't necessarily mean it's the top. Because what do we actually need to see for a top to form? Too many people have to buy too many coins at too high of a price. Now, there's another factor to this, which I've been considering more recently, which is, and who are they? Now, let's just consider those first three. Too many people, too many coins, too high of a price. This chart here shows you the percent of the Bitcoin market cap that's held underwater. So basically, you've got a $960 billion asset. Some guy bought 70,000 and he's holding a $5,000 loss, let's just say. How many of them are there? Let's sum up all of the losses they're holding. What proportion of the market cap is it? Now, if you squint hard enough, you might be able to see all of the losses currently held in this market. Now, in an absolute value, it's like 14 billion. But out of a $1 trillion asset, 1.4% of the market cap. And this, bringing things into relative terms, it looks a lot more like a typical correction. And the final piece I'll leave you with, and we'll close out this market section. So far, we've got some indicators that people have bought high and they're holding coins in a loss. The magnitude is pretty small. And if you think about the charts we've just gone through, to me, we haven't seen this kind of massive influx of people who are unfamiliar with Bitcoin. In other words, the people who are in this market, they understand what they own. So yes, some people bought some coins at a high price, but they're also hodlers. And that's, I think, a very, very big difference is of the characteristics of the people who, we are still in a hodler-dominated market. And I just look at myself in this data. And when we dip down below, it's 100,000 Australian. When we get below 100,000, my Bitcoiner in me is like, ooh, I kind of like that price now. I've acclimatized myself to these levels. And when I think about myself in the data, I see more and more and more of me. So my concerns about it being a top aren't, again, we're always vigilant. We're always watching. Things are dynamic and we just don't know the future. But my gut and my instinct is telling me it's just not as likely as a lot of people on the bears on Twitter seem to think it is. So that's my core instincts. But that'll bring us to the end. Pete, let me know if you've got any thoughts there, and we can start to move on to part two.
I agree wholeheartedly with what you've said, and anecdotally, and this is the juxtaposition between your work and the TradFi work that I spend most of my life in. Really, the TradFi is all about thoughts and feelings. How are we feeling? And there's no real objective data. What your objective data says to me sums the position up nicely from a macro perspective, that there's a lot of tailwinds to come. I think we're going to have at some point in time a drop in interest rates, even though there's inflationary pressures. We're going to have liquidity come back into the market. All of the geopolitical, there's only one geopolitical risk to this party stopping, and all of the tailwinds that we're expecting to come to stop this. So the data you present encapsulates perfectly where I think we are on a broader perspective in TradFi world. There's a lot of good things to come. There's not a lot of concerns around things that can derail what I expect to come down the track. And this is where I'll probably stop talking, because I don't want to be throw subjective thoughts into what is a great presentation of the actual on-chain analytics and data. To me, it's confirmation bias that, okay, what I'm seeing anecdotally is reaffirmed with the numbers and the underlying on-chain analytics.
And that's what I love about the on-chain side of things, is it's bringing what we probably feel and we get to see it, right? It used to be that you could only look at the fear and greed index and some TradFi RSI indicators, but now we can actually see the unrealized loss in everyone's portfolio. And the way I think about it is, show me the level that can shake people out. May 2021 this was a level that really broke sentiment. So when we get up to here, you start getting concerned, right? 2019, similar levels, and in the bear market, right? So this is the kind of thing that can break confidence. Right now, it's just very hard for me to get too concerned over something of this magnitude. So that brings us to the end of the market update component. And I think something that I've learned and spent a lot of time thinking about of late is that Bitcoin can actually be quite hard to hold. And I spent a lot of time thinking about investor psychology. And as I mentioned at the start, Onchain's goal is to be like your Bitcoin personal trainer, because volatility can be tough to deal with, right? Market chops around, you have uncertainty. Why did this happen? Why are things occurring? And volatility and surviving in markets is a mental game. It's a challenge. But hodling coins in self-custody can also it's a technical game. And one thing that I spent a lot of time thinking about recently is my own, I'm getting older, my own mortality, but also just like the practical side of like, if I didn't come home one day, would my loved ones be able to actually get to my coins, right? And I actually ran a test where I said, okay, I'm going to give you no guidance. Can you please go and spend a coin from my cold storage wallet? And the laundry list of ways that my coins could have got lost, locked, stolen, sent to the wrong address, whatever it is, there's a whole host of things that I realize that I spend a lot more time thinking about my coins, the value of them, the proof of work it took to earn them, the security system I've got, the golem level riddles that you've got to solve in order to access my keys. Like, there's all of these components that you just realize I've thought a lot more about this than my loved ones. And as you know, I'm a millennial. There's a lot of, when you look at demographics, in terms of our YouTube statistics and any podcast in this industry, millennials are the bulk of people who are interested in Bitcoin. And I start thinking, well, where are they in their journey? They're about to move into their house forming years. They've got dependents, they've got families, they've got a house they need to look after or acquire. And all of these things, and let's imagine Bitcoin does what we think it's going to do, which is appreciate quite meaningfully over the future. Suddenly your proof of work that you've been stacking for 5-6 years is now worth something that is you don't want to lose. You move from the I'm trying to win to I don't want to lose it. And that transition, it really got me thinking about multi-sig custody. It got me thinking about inheritance planning. And ultimately, this is where Peter comes in. This is what the Bitcoin advisor is all about, is trying to help you actually hodl. And if you think about this from a mental side with Check on Chain, and then a physical, technical, bringing your spouse and your family along for the journey as well, making sure that everybody is a part of that process. So, I can't think of anything worse. I know there's some memes out there that like, oh, you should, pass away with your coins and donate them to the network. Do not do that. That is not what your proof of work is for. Your proof of work is to improve your and your family's life. That's what you should use it for. It's your savings. So that's really, that's probably about enough for me. I think now we're going to move on. One thing I want to leave you with before we move on to Pete. By my estimates, 18 to 24% of the supply is lost. That's $179 billion worth of unrealized profit in coins that are probably never going to move again. I don't want to become one of these statistics. I don't want any of my subscribers to become one of these statistics. I don't think Bitcoiners should strive to become one of these statistics. A lot of these coins are from the early days, but there's still a lot of coins that go missing day to day, right? So that's the challenge that we're trying to solve with this partnership. And really, I'll pass it over to Pete now to really introduce kind of collaborative security and why this is a really interesting concept, and certainly where I think the market's going to be going.
Thanks for that very complimentary intro. The collaborative security or collaborative custody protocol that we implement, I think, is going to be something that helps not only Bitcoiners secure their legacy, but it's a way for Bitcoiners to help their friends and family secure legacy too. And this is where, for the last 8 years, I've stared at this problem and sadly expelled more mental energy trying to solve this. And this is the best that we can come up with. And I'm very fortunate that you and a number of other fabulous Bitcoiners are on the team to help us continually improve this collaborative security. And what we effectively do is we take the ability to snatch defeat from the jaws of victory away from any client. And this is where I'm really proud to say that we, through using this protocol, haven't lost a single Bitcoin. So we've avoided being any part of that 18 to 24% of lost Bitcoin. Not a single client has lost Bitcoin. And this is where, and I don't want to sort of minimize the responsibility aspect of owning your own keys, not your coins. I think it's absolutely critical that we all play that part for a number of different reasons. Firstly, for control, for self-sovereignty, but also for number go up technology. It's critical that we don't have coins centralized. But in a collaborative security environment, what you do is, and what we help provide is, ensure that there's no single points of failure. And this is a particularly important part, as either one of two things typically happens in a life event, and that is your stack increases to a size where you're no longer comfortable looking after your Bitcoin or being responsible for, say, hundreds of thousands or millions of dollars in Bitcoin, and you want assistance with that. Or alternatively, and you alluded to this earlier, James, you now have dependents who are relying on the wealth you've created with your Bitcoin to continue on in the lifestyle that they're accustomed to. And a very quick way of determining whether or not your security and your protocol is sufficient to meet the demand if something were to happen to you is to literally ask the question that you asked your family, which is, hey, I want you to move a Bitcoin and let's see how it goes. And quite often the time and effort that we put into securing our Bitcoin is way over what our family's level of expertise and understanding of our security protocol is. And this is the mismatch of that typically leads to either the lost coins or something happening by way of loss or theft or God knows what. So collaborative security is a way for leveraging off professionals in the space to avoid becoming a statistic. And really that's all we care about, that we want to ensure that our clients, having put this much effort in, and if you're on this call or watching this podcast playback, you're deep down the rabbit hole and have spent an enormous amount of your physical and mental energy in getting to this point that you want to protect your Bitcoin for future generations. Personally, out of all the assets that were presented in the investing world, there's no greater asset to leave to your future generations than this. However, there's a small complication to this asset in that there's no appeal to authority if you muck it up. So every other asset that you've got, whether it's outside of perhaps gold, but if you've got a property to leave, if you've got stocks to leave, if you've got goodness knows what, businesses, the like, there's always an appeal to authority or a government body that you can appeal to get that asset back. And the problem with a digital bearer instrument when you're self-custodying that is that there is no one to appeal to if something goes wrong. And there's a lot that can go wrong. And I look at some examples that we've spoken to clients who have come on board after having some serious type issues with their self-custody. They've, some clients have been had their Bitcoin stolen because they've shared seed phrases with the internet and they've been rinsed of Bitcoin. There are others who have lost their devices. There's others who have been caught up in scams. And I think because of the very nature of where we are at Bitcoin as a frontier asset, that if we're in Bitcoin now, we're probably, very much on, the far right of the curve when it comes to risk taking and understanding this. And it's a very specific personality type who is involved in Bitcoin at this point in time. That is a personality that typically does things by themselves. And this is where the social component we try and implement with a collaborative security environment reinforces all the work that you've done to further enhance and improve the security setup and, most important, the recoverability of clients' Bitcoin. So we've got a very proud record of going through a number of probates now with clients who have sadly passed away, and we haven't lost a single Bitcoin. So we've been able to pass self-custody Bitcoin effectively from the grave, which is a great accomplishment that I'm not too sure a lot of Bitcoiners would be able to say that if they were to pass away. And this is where that question to loved ones on recovering your Bitcoin, hey, go and have a look at this and try and move one. If the answer's not satisfactory, then it's probably really important to come back and have a chat and see if we can help out in that capacity.
Yeah, and I think it's, you run through these experiments, right? And a key part of that test is you can't give guidance, because when you kind of watch all the different ways that things don't quite go to plan, right? They download Shallow Wallet rather than Sparrow Wallet. Coins go to Nigeria, right? They send it to a different address. They don't know how to copy paste. And remember all the times you've done your own test transactions, and also there's a peace of mind component here, right? having, and again, the beautiful thing about this, what I really love about the collaborative security approach, is it is still self-custody. But what you're doing is you're removing, I mean, everything in this world as an engineer, everything is trade-offs. There are no solutions, there are only trade-offs. And self-custody being a steel plate buried in your backyard and a cold card, I love my cold card. I use it all the time. I think it's an amazing piece of hardware. I got my partner to use it, and it's just not going to work long term. I love it. I love it to bits. I'll always use it, but she can't use it. So there was this like component where it's like I recognized that the single point of failure that I probably had spent the least amount of time actually thinking about was me. I didn't realize that I was my own worst enemy when it comes to my security. I had thought about it a lot more than my loved ones had, and more importantly than I should expect them to. Right? They've really I've thought about my proof of work a lot more. So, Pete, I know you've got lots of great stories that kind of illustrate this point. We've got a couple of key elements here, right? The inheritance side, loss or theft, jurisdictional risk, but also that like peace of mind. At the end of the day, to me, that's the big part of it. Having the security, the peace of mind, having your family and your loved ones come along for that journey with you. Have you got any kind of great stories that really bring this home and kind of show what this means in a practical and real world scenario?
Yeah, I think there are a host, and probably some of my favorite stories are from clients who were originally very skeptical of the service that we deliver. And there was one client in particular, I'm thinking of, an absolutely gorgeous lady who was very diligent, very OCD and process driven in her approach to understanding what we did. And within a month of setting up her Bitcoin wallet and the rest of it in this collaborative custody, she called me in an absolute panic, talking about the fact that she'd lost not only her device, but she'd lost the seed words, and she was terrified that she'd lost her Bitcoin. And very fortunately for us, I said, no, that's no problem at all. Come in. We're going to basically redefine, recreate your wallet, your key. We'll just sweep it to a new wallet, and all is said and done, you won't lose any Bitcoin. And the relief of, oh my goodness, I haven't lost it. And this was, at the time, talking about millions of dollars in Bitcoin. And this is the problem that I face as someone with a fiduciary duty to clients, is that letting clients walk out the door with a single sig wallet and millions of dollars on a Bitcoin that they could lose, that they're not used to, looking after and custodying themselves, I think is just irresponsible. And so for me, the collaborative security environment allows them to have all of the features of self-custody without the concern of ever losing it. And this is where they can muck up everything that we could possibly do. Well, there's literally no avenue for them to lose their coins, because there's a safety net that catches every single point of failure. And one of my favorite stories, which is kind of a side event to what this is, but there are parallels to Bitcoin, is one of the fund managers we work with is a very successful investor out of Switzerland. And he talked about the fact that he buried one of those gold bricks in his backyard. And he'd buried it years and years ago, totally forgotten about it. And he's sitting in his home office one day and looking out, and there were a host of workmen who had come to dig the backyard up to put a pool in. And there's trucks, there's workmen all through the site, and he's had to run downstairs. He's realised that he's got nearly $1 million of a gold bar sitting in the backyard, and he's got to go spend the time digging up the yard, but he can't have 20 people watching him do this. So he's called the whole thing off and sent them home, and he spent the rest of the day basically digging holes in the backyard trying to find his gold bar. Now, finding a gold bar in a backyard is far easier than finding a private key for your Bitcoin. And I sort of say this facetiously, but this is the beauty of having collaborative security, is that when you've got experts in place, it allows you to triangulate far easier where the Bitcoins are, but you can't move them. And so I look at this and think there are a host of other stories where we had one client who called us on his deathbed, and I was speaking to him, and he's literally came down very quickly with a severe illness, and he was likely to pass away within a week, and he could barely talk. And he said to me, "Peter, I need you to move my Bitcoins to my children. Can you do that?" And I could barely understand what he said, but I knew what he was saying. I said, "Sure thing." Anyway, we were able to create vaults for the children and the rest of it. Saw them within a 2-week period and then had them all ready to go. And one of the kids was leaving his home 2 weeks later. He happened to make a miraculous recovery, which I was absolutely thrilled about. But a very funny turn of events, they were walking out the door to see us, and the commentary was, "Oh, where are you off to?" The child said, "Oh, I'm off to see Peter to move your Bitcoin to my account." And now that the client had recovered and was Scopus Mentis, had everything together, they turned around and said, "You are absolutely not moving any of my Bitcoin. You can sit back down." So once that had returned, and there was basically the relief of, okay, I'm not dying and I don't need to move my coins, but in the event that I did, I would be able to do it. These are the things that I guess we need to consider as Bitcoiners, because there's no other avenue to do that. There's no legal recourse that we can take to speak to a solicitor to move the coins, or there's no exchange that we can talk to when it comes to stock exchange with respect to share certificates, or a land titles office with title deeds to change the name on the title deed to the beneficiary.
Yeah, no, it's all these interesting components that you really have to sit down and think through all the ways it can happen, and even just designing the inheritance plan, right? What is the actual inheritance plan that you want to get executed? And there's a lot of people will initially say, well, hang on a second, doesn't that mean that Pete can go in there and get his hands on my coins? But that's not how these things are designed, right? It's designed so that you as the client will always have, they are still custody by yourself. What you essentially have is those fail safes. Should you lose your keys, then Pete and the whether it's Unchained or Thea or any of these other parties, they can essentially rebuild that key and bring it back online because they're using the multi-sig structure. So the theft is gone. There's also the component where you have entities in different parts of the world. If jurisdictional risk is a part of your threat model, rather than distributing your seed plate right across different parts of the world and hoping that the person on the other end isn't playing funny games, you've essentially got regulated and entities that are resistant to that kind of thing, and also to execute, design, and build out the estate plan. How does that work should the worst happen? So to me, it's a very holistic approach. I think it's something that a lot of Bitcoiners are going to reach a point in their life where this makes a lot of sense. When I spend time thinking about the Bitcoin industry, we've really got three major industry pillars. There's mining, there's exchange infrastructure, and there's custody. And I really believe that the custody side of that equation is something that is going to grow significantly in coming years. I think the demand from Bitcoin is going to be much, much larger than people expect. And it's just it's a process, right? As we all go on our life's journey, for some of us, self-custody will forever solve that problem. But for others, as your life changes and dependents change and circumstances change, it is likely that your self-custody setup there are options for it to evolve alongside your life, which I think is really what this is all about. So that brings us to the end of the session. If you do have any questions, please drop them into the chat box, and Pete and I will go over them. There's a QR code here. This will take you to our Check Onchain landing page. So just to give you a bit of an oversight, essentially we are a partner with the Bitcoin Advisor. Essentially we believe in this thing, and at Check Onchain, we value honesty and integrity extremely highly. So we do not take partnerships without really putting a lot of thought behind it. We believe in the product and the team that Pete and Andy have over there at the Bitcoin Advisor. We think it's a fantastic model. We think the demand is going to be there. We're certainly not the kind of entity that wants to have ads and sponsorships everywhere. So this is something that we truly believe in. And I think, Pete, thanks so much for coming along for this podcast. So if you do want to check out our landing page, there's a QR code there. It's got a video from me talking through a lot of these components, as well as some of the key features and a form if you're interested. So, Pete, just while we're waiting for some of those questions to come in, I'd love to get any kind of anecdotes or stories, right? I mean, I'm seeing in the data the institutional scale. I'm curious from your side, what are you seeing in terms of sentiment? What are people talking about? What is from the asset manager perspective, right? Where is their overall sentiment at around Bitcoin? How has it evolved, particularly over the last 18 months?
I think the biggest thing has been the success of the ETFs. That's been a very clear message to institutions that there is demand for this. There is the ability to build a business on the back of it. I don't think traditional finance had the ability to think through what are the type of businesses that they can build with Bitcoin, particularly from traditional Bitcoiners, not your keys, not your coins, very sort of adversarial to traditional finance. But then Larry comes along, releases an ETF, it's the best one ever. All of a sudden, it gets everyone thinking. And to me, traditional finance, I think, is looking at this and thinking, wow, this is a product that we can actually build a business around. And the initial thoughts of allocation to Bitcoin was, to me, going to be where I started 8 years ago, which was 1% to 2%. However, the conversations I'm hearing is, no, we want an allocation of 3% to 5%. So that's a big shift in numbers from 1 to 2 to 3 to 5. And Larry anointing Bitcoin as a flight to quality has a big appeal to traditional finance.
Yeah, no, it makes sense. So we've had a first question come in, Pete. How long does it usually take to get set up as a client once the decision is made to having AUD exchanged for Bitcoin and then safely held in collaborative custody? And I might actually just throw in one extra point to that. So there's a question about the duration that it takes, but also if you've got any insights on, we were talking about family members and spouses before, kind of the confidence that this system can actually give to both sides and the whole family unit of having actually seen that they will be able to get access to it. So there's like a duration thing, but there's also a bringing everyone along for that journey at the same time.
In response to getting that set up, it can vary. We can get that done with an exchange. Typically, it's 24 to 48 hours setting up an exchange. And then the vault and the multi-sig setup can be as quick as 15 minutes. And we've got some rollouts to improvements in the process on that happening as we speak, which should be implemented within the next week. But it can take a lot longer. It really comes down to the motivation for doing it. So the fastest process that we've seen from start to finish so far has been 36 hours. And ironically, that was a client, God bless his soul, he and his wife were 84 years old. And we first spoke to them on a Wednesday afternoon at 4 p.m. and they were all sorted in their Bitcoin vault by Friday at 10 o'clock.
And just Pete, any kind of insight on bringing the family unit along? So I mean, obviously these timelines are compressing quite meaningfully. What is it like to actually have all parties in the room at the same time and kind of along for that journey?
That to me is the favorite part of this for me. Like helping Bitcoiners get more Bitcoin. Obviously, our primary objective is to get coins off exchange into self-custody. But the real kick that I find as an advisor in this capacity, and I think a lot of the Bitcoin advisors do, is helping Bitcoiners get more Bitcoin. And if you break that down, what's typically the inhibiting factor for getting more Bitcoin in a family type environment? It is the fear of losing what you have in Bitcoin. Now, most clients have seen their Bitcoin go from an insignificant allocation to a meaningful amount of their net wealth. And then the concern starts with, and I don't mean to make gross generalizations, but because Bitcoin being what it is, it's typically very male oriented. And so it's typically males have made the decision to buy Bitcoin, and the family, the wife, the children, the rest of it, who are depending on the wealth of that individual to live a life, are concerned about the recovery of it. And so that's typically a limiting factor for allocating further capital to it because of the lack of technical understanding to recover it if something were to happen. So when you remove the concern around the fear of loss of the Bitcoin and you integrate as a family environment that, we're not magic internet people sitting on the other end of a telephone line in Nigeria, like we're real life people. We've met in real life. You can actually come to the office, see us, meet us, touch us, feel us, and you can alleviate any concern of fear of losing your Bitcoin. That opens up the optionality to then apply further capital to the pursuit of more Bitcoin. And that to me is the most important thing for our clients, is that a lot of clients look at the fact that we charge a fee, and we understand that we do charge a fee, but all of the clients that we work with end up with more Bitcoin by working with us because we're professionals at finding more Bitcoin for them. And a lot of the stumbling blocks to getting more Bitcoin typically revolve around family concerns that they aren't in a position to recover the Bitcoin that they've got. So obviously, the family doesn't want to allocate any further capital to an asset that they may never see. But when you remove that concern from the family and can actually develop a relationship with the family and ensure that, and we can demonstrably prove to the family that we can recover the Bitcoin, then all of a sudden it's a complete mind shift to, okay, well, rather than limiting the capital that we're going to put there, we've just watched the capital go 10x. We need to find other other sources of capital to buy more Bitcoin because this is our best performing asset. So it's a complete 180 from a family dynamic perspective, which is an absolute thrill for me to be part of.
Yeah, absolutely. So there's a couple of questions here that I can fly through and answer quickly. The first one from Stefan. Yes, this will be recorded. So if you're on our Substack, you'll get access to this very, very shortly. There's a very quick question here about MVRV and cycle tops, which is a very common question that I get. Really, what is MVRV? It's people's unrealized profit or loss. The higher it goes, the more likely people are to spend. So those pricing bands that you're referring to, think about them not so much as a price target. Think about them as a level where investor behavior is expected to change. So if I think about it from my perspective, right, whatever that model is, it may not be my price, but I personally do not think that now is a good time for me personally to distribute my Bitcoin. I'm going to sit tight and wait for this cycle to play out. If we allow this cycle to go on and on and on, there will come a time where we are trading up at the upper bounds of those MVRV levels, and that number will look relatively attractive. And it may not even be attractive for me, but it will be attractive for other people. And remember, just because you didn't sell doesn't mean that someone else didn't. And the nature of those things is it's not so much about a target, it's about a point when investor psychology can and will shift. And that shifting is their selling. And that selling is what creates tops. So that's the better way to think about it. So until we get to those points, you can probably assume that investor psychology is going to be more favorable to sitting tight and doing nothing. There was another question about the hash ribbon. So the hash ribbon is a very interesting metric because I would put it in the bucket of being, it works because it will always work, but it's not the signal. So let me try and explain what that means. Miners are a cutthroat, ruthless business. If you wind down their profit by 5%, they start to capitulate. They're not talking about making stacks and stacks of money here. They are on the edge at all times. So essentially, any and all downturns will probably stress out the miners unless you're in a raging bull market. And then they're basically, usually in a raging bull market, they're investing way too much money in way too many machines, and they're going to wreck themselves anyway. So the fact that hash ribbons decline, the signal is that we're probably having a pullback, and a pullback creates stress, but it creates stress for the miners first and foremost because they are such a cutthroat business. So I like to look at the hash ribbons to say, are the miners stressed? It's a binary yes, no, measure it by percentage. That's about it. I don't spend a lot of time being like, this is the signal, because there's so many other signals which, in my opinion, tell that story at a much higher level. Now, a question here from Dave, which is to you, Pete. Pete, is multi-sig really self-custody? It seems more like a co-trusteeship. Am I wrong about that? And I think this is actually a really great way to kind of isolate what is the difference. Well, what are the pros and cons, trade-offs, and balances of multi-sig versus single-sig?
Yeah, it's a great question. And this is where in the multi-sig arrangement, when you have a 2 or 3 quorum, as we do, we structure it whereby we have a multi-sig provider holds a key, client owns that account and the control of that key, as well as control of their own key and the control of our key. So we have a fiduciary responsibility to action any request from a client. We're bound by the law of New South Wales, Australia. So, it's a fairly rigid legal system. It's effectively developed on the back of British law. So I think it's a pretty good one. When it comes to the question around trusteeship, I don't think it is trusteeship because we're only holding one of the 3 keys. So we have no control over what can happen. And this brings me to a point where the point in time where we are now when it comes to multi-sig, it's an evolution. So this software is evolving. And one thing that we're working on behind the scenes, which will probably alleviate 100% of the concerns that you have, Dave, in this type of arrangement, is we're working on programmable multi-sig. And what that means is that you'll be able to have the client key as the master key in the multi-sig setup, so that unless the client key signs, the other 2 co-signers won't be able to sign a transaction to move the coins. And so what we'll be able to prove cryptographically, which is about the proof I need at this point in time, given what our institutions have told us over the last 4 years, the only truth I believe is cryptographic truth. We'll be able to cryptographically prove to you that coins can't move unless you, as the key holder, as the client, initiate the transaction. And now there are fail-safes that we can build in and around that, which are going to protect you if you lose access to that key. We can have a decaying multi-sig, which removes that condition. But this is where the multi-sig, to me, represents the future, because we can alleviate that concern around full control and ownership by the client, but also have the redundancies in place to ensure that we're not going to lose a single coin in that environment. So I look at that and think, we really kill two birds with one stone. We address the collusion concern, which is to your point, and most importantly, we deliver the full control to you, while not compromising on any of the redundancies that are already in place with the current collaborative security setup that we've got.
Yeah, that's great. And I think Kevin's asked a question which is very related to this, which is multi-party computation, MPC, and basically the evolution, how multi-sig custody is evolving. Do you have any thoughts on what that custody technology, what's the evolution of this? What are some of the things you've got on your longer term kind of road, not necessarily roadmap, but ideas that are playing out in the market?
Multi-party compute, I can tell you, has gained great traction and interest from the major institutions. And this has probably been brought about by a lot of the work that Fireblocks has done. They've been instrumental in creating platform technology which enables a much easier control of large amount of accounts, and it has a programmable set of keys. It's cryptographically secure. To me, call me a little old-fashioned, I still like clients to have a hardware device. I like the fact that they've got to create their own entropy when it comes to the seed words. I might be showing my age, being quite the Neanderthal and backward thinking, in that maybe I'd just like to see a few more years of this multi-party compute without any compromise to that system. Call me a little cynical, but I'd just like to see some runs on the board. I'd like to see that Lindy effect take place before we want to adopt any technology which could lose coins. And ironically, with multi-sig, this is a technology that's been around for nearly 7 or 8 years now. And I'm proud to say that what we've worked with our multi-sig providers, we haven't lost a single Bitcoin doing it a certain way. And Michael Saylor tells a very amusing story about the fact that on the aircraft carriers, when the planes land on the deck, there's basically a rope, and they've got 3 people counting the fact that how many times this rope's been used before they've got to change it. And he said, why do you do that? And it's like, because it works. And you could easily replace that technology with something easier, faster, save 3 salaries, and you could have a calculator count how many times this rope's done, but they don't. They use 3 people to count it because this measure has worked in the past, it still works moving forward. And this is where, when it comes to people's life savings, we want to make sure we're working with something that works, and a Lindy effect proves out over time. And this is where, when it comes to new technologies, I personally am very slow to adopt any new technologies when it comes to the security of my Bitcoin and the security of the protocols that we're working with for our clients' Bitcoin. Namely, for the fact that all of the implementations that we put in for clients, I have my Bitcoin in the same protocols that all of my clients are in. So I have just as much to lose as my clients in doing this protocol change. So for me, we move very slowly, very deliberately. There's a huge amount of due diligence done on the service providers that we work with when it comes to custody, and we want to work with things that have got a long track record of working. So for us, the multi-party compute is going to be interesting. I think the banks are going to adopt it far sooner than the rest of the industry, only because they've got a scale problem. But I'll be very interested to see how that plays out.
Absolutely. So there's some last final questions, then we'll wrap things up. So there's one about, according to Google Trends, an overall rise of stablecoins in market cap. It's likely that we haven't seen new investors coming in, which I agree with, meaning that this cycle is yet to unfold. The ETFs, the average investor was about 13,000. So that I assume that's 13,000 in terms of buy side. So my general view on the ETFs is what we've seen is a lot of it seems to be retail driven. And I can't help but think it's very hard to get data in the TradFi world. I can't help but feel that there's a lot of Bitcoiners who've just been waiting and chomping at the bit to get their 401ks and their retirement plans allocated to Bitcoin as well. So I think there's definitely a big component of that. But slowly but surely, there was a video that was circulating recently. I think it was the Wisconsin Pension Fund. This is one of the most conservative pension funds in America. fully funded, fully allocated, and they allocated a 0.1% of their portfolio, 0.1. And this is $180 million. So, these, and their expectation is to move from 1% to 2%. So, we are talking about large pools of capital that are only the furthest along the curve. And he actually, when they were talking about it, were not describing Bitcoin as a risky part of the portfolio. They're describing it as a common sense part of the portfolio, which I think is really, really powerful. So there was one last question here from Murray. Yes, in terms of the Substack, and there's actually another question here about clients and Bitcoin Advisor getting access to Check Onchain. So all of our charts are actually free. So you'll find them if you go via our website at checkonchain.com. But in terms of our Substack, we'll be sending around both this webinar as well as a kind of a setup to get Bitcoin Advisor clients and Check Onchain clients, and kind of gluing those two together. Because as I mentioned, this is a partnership. So yes, you'll be hearing more about that in the very near term. Actually, this is a really good one, I think, from Stuart to maybe close out on. ETFs versus self-custody. Is the trade-off of full self-sovereignty worth it versus the hassles or risks of multi-sig? This is actually a great question. So it's almost like almost like a rapid fire: single sig, ETFs, multi-sig. Why in your opinion, does multi-sig, where does it fit in that story?
That's a great question. I personally want to hold the underlying asset. And to me, single sig represents too big of a risk to do that. If someone finds the 24 words or 12 words, they can take my Bitcoin, and they might find the words and then 5 years down the track decide to empty my wallet. I'm not going to know until the wallet's empty. So single sig has a host of problems that I personally wouldn't feel comfortable with intergenerational wealth. The ETF, I love the fact that clients can have access to it at the press of a button. They're using traditional financial rails that aren't going to inhibit, large volume purchases of that. And I think the recent announcement that we had in Australia with Monochrome and their ability to take in-kind both deposits and redemptions in Bitcoin is a huge thing, which hopefully puts pressure on our American brethren to create a similar type outcome. For me, though, when it comes to an ETF versus owning the underlying, I always want to own the underlying because it gives me optionality. And the way we're trying to think about how to position clients moving forward is that this is the best form of collateral ever invented. And if you're holding the best form of collateral ever invented, there's going to come a time where you're going to be rewarded in the future when you want to borrow on that or borrow with that as collateral, with the best interest rates, the lowest interest rates, and the best credit terms. Now, if you're holding an ETF, you're not going to benefit from that. You're going to benefit from margin lending rates, which are going to be typically at somewhere between, call it 3 to 8%. You're not going to get any better than that. Whereas if you hold the underlying, one thing that's very interesting about Bitcoin is because it's globally ubiquitous all over the world, this is the first asset that you can take to any bank on earth, and it's going to be the same. And I think about this and think, what are the opportunities to take advantage of, say, the low rates in Japan by taking out a loan with a Japanese bank by using Bitcoin as collateral? Now, because you're using Bitcoin as collateral, there's no foreign exchange rate risk in the repayment of that loan. So you can just access interest rates at 1.5% versus the US at probably 7 or 8%. So I look at this and think, if you're holding an ETF, you're subject to that jurisdiction and the margin lending requirements on that and the interest rate that jurisdiction is charging. If you hold the underlying, you can take that asset all over the world in an instant. So for me, I always want to hold the underlying, and I want to hold it in the best way possible, and I'm not going to have any points of failure, and that is collaborative security.
And I think one thing that certainly for me, there's two components there that I think really, really stand up to scrutiny. The first one is if we really do believe, and some people believe there's going to be a goldification risk where you actually have some scenario where they can rehypothecate and short sell. They cannot short sell and rehypothecate your multi-sig coin. So in that regard, you are taking full ownership of them. But the other thing is that you can move Bitcoin wherever, right? With the ETFs, you are essentially stuck in that. If your brokerage account is down and you can't access it on the weekend, that's it. It's too late because you cannot do anything. All right. You can only use your Bitcoin during the working hours of 10 to 4, Monday to Friday. Bitcoin is a 24-hour asset. You never know when, why, how you need it. the ETF, it is essentially a walled garden. And in many ways, consider it the same way as a stock. I've tried to buy gold many times. I own some gold. I own it via an ETF. I own it because if I need that liquidity, it's there. However, if I need that liquidity on a Sunday, I can't do anything about it. So my Bitcoin is going to be available to me. So I think that's another really important component, that you are ceding sovereignty when you use something like an ETF. It will be the right solution for some tools, but not necessarily for all of them. Okay, I think we're getting to the end of it. I'm conscious of time. Let me just check this last question here. With a move overseas in the future, he's holding his Bitcoin in a self-managed super fund. It isn't a long-term strategy, and holding as an individual has cap gains instances. When I become a non-resident, do you include advice around tax-effective structures for this type of scenario? Pete, so that's probably over to you. That's kind of in the more of the advice side of the equation. What are you guys doing with that kind of thing over at Bitcoin Advisor?
We'll work with accountants. So I have a working knowledge on self-managed super fund, have an equivalent of a master's degree in self-managed super funds, and wrote, ironically, a long time ago, feels like another life, wrote a course for the mortgage industry on limited recourse borrowing arrangements, which is a superannuation product. When it comes to offering advice in this, we give general advice. However, we want to work with your accountant to ensure that all of the work that we're doing is going to meet any regulatory concerns. So we probably know from practical implication or implementation how to do that, but we want to talk to your accountant on what we're planning to make sure that not only themselves, but with self-managed super funds, we have an independent auditor. They need to be au fait with what we're planning to ensure that there's no contravention reports, which is where you get in trouble with a self-managed super fund. So happy to work with professionals, but want to do that in a collaborative way.
Fantastic. Well, thank you so much, everybody, for tuning in. We really, really appreciate it. Hopefully you found something new, kind of learnt about the world of both on-chain analysis, but also in terms of collaborative custody. Pete, thank you so much for joining this webinar. It's been a real pleasure. And as I mentioned, we'll send around this recording to both of our audiences in the very, very near term.
Thanks very much. It's great.
Cheers.